And we are live. We'll just wait about 30 seconds for everyone to get the notifications and hop on here, and we'll get the show on the road.
Cool.
Sometimes I think they shadow ban me, because of some of the things we say on
Because it takes so long to...
Yeah, it takes so long. You sometimes see the viewers, and you can actually see if there's things that I say or words. They like viewers drop off. Like,
Oh, really?
It's like they do something with this. They shadow ban us sometimes. So
it's cool seeing it from the back end.
Yeah,
I've only seen it from the other side.
There we go. Well, we've got a few guys online. If you guys can hear us and see us, push a like, say hello in the comment section, and we'll get the show on the road. I've got lots of exciting things to talk about today that will be controversial, and things to protect you folks watching. So, just got a like, that's great. It takes about a bit. What are you eating dinner? Whatever.
Perfect thing to eat dinner to.
Yes. It's going to be the topic. Matt, how you doing, Matt? It's going to be a topic of discussion. I've got a lot of food to talk about today, actually. Funny enough. I actually do. Macca's, KFC, Chick-fil-A, all different things. So, all right, let's get rolling. Thanks a lot for tuning in for tonight's Tuesday Night Live. I have a special guest here today. I've got Tim from Zinger Finance, and today we're going to be talking about finance and not setting up a self-managed super fund, but exploring the options of self-managed super fund and all that sort of stuff. So thanks for coming on today, Tim.
Thank you for having me.
Pleasure, mate. Pleasure. We'll maybe start with a little bit of, as people are starting to load on, and I'll get into the news articles first, and people will join in as we're going through the news, and then I'll ask you some questions about yourself, and just what we'll talk about your portfolio, and
Cool.
Get started. So today I've got some news articles, and I'm going to flick through them very quickly. This one here is the first one, and it says Britain's inflation rate could be about to drop below the Bank of England's 2% target. So economists see the latest UK inflation print out Wednesday, taking the headline rate to near or even below the Bank of England's 2% target. That's largely due to energy prices that took a sharp fall in April, etc. So I'm not going to go too far into this article. I'm just going to run through most of them. I've noticed across the world, every country that's out there, their inflation figures is falling, right? And what does it mean if your inflation is falling? Does it mean that prices are going to come back? No, right? That's the way everyone's going to get stuck. When inflation falls, it just means that you're being robbed a bit less, right? So inflation, if you go to the shops and you look at a hamburger and it costs $5, and inflation goes up by 2%, well, then that's 2% of $5, so it'd be like 10 cents. So the burger's gone from $5 to $5.10. But the reality of it is that things are going up much faster than that. It's not all being reported correctly. It just means you're getting less money stolen from you on a rapid rate. So, but that is an interesting news of that. One thing that has come off the back of these inflation numbers falling is the bond yields. The bond yields are basically, as I've said for a very long time, for you guys, are a very good indicator of what's to come. If the bonds are rising, whether we're looking at the 3-month or the 2-year or the 5-year or the 10-year, generally the US on a 10-year bond rate is where the fixed rates for mortgages sit at. And they're starting to fall backwards, and that's due to the fact of liquidity in the system. So we're getting closer to an interest rate cut as we go week by week. Second article of the week, this is pretty funny, right? McDonald's franchisee group says $5 value meal can't last without company investment. So we're in a world, I'm very cautious about what I say about these large corporations, because some of them, like McDonald's, have a lot more money than I do. And, if I say something out of line, they could come and sue me because they might not be McLoving it. So, so this article here, basically, there's a lot of news coming out. The people who eat McDonald's majority, it's targeted towards the poor people, right? Families that, all they can afford is having that as a takeaway. So it's been marketed towards, a certain segment of the market. You're not going to high-end suburbs and seeing McDonald's everywhere. You go to the most family area, everyone's in their Tarago on that, and you see, a lot more Maccas. Every corner there's a McDonald's on it. And that's who their market is. But due to inflation, the cost of goods have gone up so high that poor people can't afford McDonald's anymore, right? And there's a big issue because McDonald's and all the restaurants are starting to struggle a little bit. And I never would have thought that, somewhere like McDonald's or KFC would be, one of those companies that could get into some sort of financial strife.
Too big to fail.
Too big to fail, yeah. But there's struggles here. So we'll read this article. I forget which. It's from Bloomberg. It says here, an independent advocacy group of McDonald's franchises is weighing in on the company's upcoming value meal promotion. It cheers affordability to the consumer, but pushes for future contributions from the company to make the discounted offering sustainable for its operators in the long run. The $5 value meal will hit the boards beginning June the 25th and last roughly a month. So it's only 1 month, right? And this is in the US, this is not in Australia. So it says here, the independent group says that McDonald's franchises, it says that, the fact remains that in order to provide the consumer with more affordable options, they must be affordable for the owner and operators. McDonald's vast resources and financial investment are essentials to any sustainable, affordable strategy, the board of the National Owners Association wrote in a letter to membership. This letter calls McDonald's business model a penny profit business with only 10 to 15% margins. And they say there is simply not enough profit to discount 30% for this model for it to be sustainable. So they got people coming in. Mark just wrote here a Mick bailout. It's real, right? So if Macca's has to give a loss leader of doing a $5 meal, then they're losing 15% on that meal. So that means not only are they losing on that meal, that means that meal plus the next client that comes in to get a meal would mean they made nothing out of those 2 meals. So the Macca's franchise owners have got the shits because they're giving away money. Like they're paying more for the cost of it. So it goes on to say, CNBC reported last week that the $5 value meal would be hitting the menu boards June 25 and lasting a month. It will include a McChicken or a McDouble. So it's only like a double cheeseburger or a McChicken, a 4-piece of nuggets, a fries and a drink. The combo would be substantially more than purchasing those items individually. Well, that'd just be like one of those meals, like going back 5 years ago, they had the $1 menu and the McChicken was on the $1 menu, right? You remember the $1 menu? It was on there. Now we've got a $5 meal and they're going broke because they've got 4 items on there. So it's just kind of interesting. The offering comes as low-income consumers pull back from certain restaurants and face a stubborn inflation, and brands look to offer greater value to customers. CNBC reported that Coca-Cola had added marketing funds to make the deal more appealing for McDonald's and its franchises after an initial proposal did not pass internal hurdles. In a statement last week, Coca-Cola said, "We routinely partner with our clients on promotional programs to meet consumer needs. This helps us grow our business together." McDonald's declined to comment on the NOA letter to its membership. In a statement to CNBC last week on the value meal, the company said, "We know how much it means to our customers when McDonald's offers meaningful value and communicates it through national advertising. That's been very true since our beginning and never more important than today." The company has previously noted cash flow for US franchises are up nearly 50% on average since 2018, even when accounting for inflation. 2023 was set to be one of the best years for the franchise's cash flow in the company's history. Beyond the $5 promotion, the NOA letter goes on to suggest the company should continue to innovate on the menu, bringing back such items, blah, blah. Anyway. So it's just interesting that Macca's is making the headlines. Someone just said here, McDonald's in America is more expensive than Australia. I'm seeing that, right? I see on these news articles and comments on forums and different things out there on all different types of Twitter posts and stuff that, when I look at the price, I'm like, is that Aussie dollar? Is that Canadian dollars? Is it New Zealand dollars? It's like the rate that they're going up, like the difference might be $10 to $14. But it's like, hang on a second, it's etching in. It's like removing the loss of currency conversion there, which is interesting. Here's some numbers, right? These are actual numbers of their price increases, just so you can get to see a little bit about what has happened, right? They're reporting inflation has gone up 2%. Let's just get this right. Inflation, the government has never come out. They said the highest level of inflation is at 7%, right? The 7% inflation that we've got. So if you had 7% last year, this year, next year, whatever, so 5 years of inflation at 7% would be like 35%, right? But let's go through and look at each item of McDonald's. So 2019, the price was $1.79 for a medium chips in the US. Now the medium chips is $4.19. So it's up 134%, right? I ain't seen that put in the inflation figures, right? McChicken, you say? $1.29, now $3.89, increase of 201%. A Big Mac, $3.99, 2024 is $7.49. This is in the US, right? It must be $10. I don't know. I don't go there anymore.
Me neither, to be honest.
I miss Maccas. I love it, right? But yeah, 10 nuggets. That's where they get you on the nuggets, right? Because that's where they fill them full of fucking chemicals, right? They're all full of chemicals. But anyway, 10 McNuggets. 2019 price was $4.49. 2024 price $7.58, up 70%. A cheeseburger in the US was $1, and now it's $3.15. Do they sort? What's the cheeseburger price in Australia? Like, I don't even know.
I can't. Yeah, I can tell you.
A Happy Meal. Imagine what a Happy would be like. A sad meal. Taco Bell price increases. A beefy 5-layer burrito end of 2019 was $1.69. Mid 2024, $3.69, up 118%. We can keep going through. Here's Chick-fil-A. A deluxe chicken sandwich at the end of 2019 was $3.65. Today it's $6.55. They're the numbers. They're the facts, guys. I'm not making these things up. They're stated numbers. So it's just interesting. Here's the article. This one's from like Bloomberg or something like that. McDonald's stock slips as CFO says lower income customers are cutting back spending, right? So that's where my statement beforehand is like the lower income, right? The poorer, the most vulnerable people out there are the ones that are stuck. McDonald's shares slipped close to 4% on Wednesday. 4%, right? You might go, 4%. They'll put in the inflation figures, right? When you've got stocks falling by 4%, inflation going up by 3%, what's really happening to your investments? That's just in one day. It fell after the CFO said the fast food chain faced challenging environment hindering sales in the opening months of 2024. The McDonald's CFO Ian Borden said lower income customers have been pulling back spending on fast food and other types of restaurants. The fast food giant says it wants to raise the share of its chicken market and plans to test the bigger burger. McDonald's shares, blah, blah. You're starting to see food at home inflation versus food away from home getting back to its more. I think historical dynamic, which means I think some of these consumers are just choosing to eat at home more often. Borden also touched on the severe winter weather in January. Get over it. They're using excuses, right? They love using excuses, not saying we're fucked. They use different terminology. We've seen the negative interest coming through us because of the winter weather, right?
Gotta make themselves look better somehow.
Exactly. They're going to fix it up. They're going to put a few bigger burger options in and improve the coffee. That's their excuse to it, right? But it's something very important I think we should be keeping an eye on is these companies, right? Because the inflation just starts hurting, right? But at some point, like if you see a double the cost of $1, it goes from $1 to $2. But you see double the cost of $5 goes from $5 to $10. So you double the cost of $10 to $20. The velocity of this inflation, as the money starts losing all of its control, will get out of control. Like it's like you'll see $1 go to $2. Who cares about that? When it goes $50 to $100, when you're paying $100 for a Big Mac meal, everyone's fucked, right?
Yeah, you see it then.
And then, so then that's McDonald's, right? This is ironic, right? KFC parent Yum Foods reports surprise drop in global same-store sales and weak demand. I say it's ironic because Tim here is from Zinger Finance. Zinger never came from KFC, but it's
Not sponsored.
We're not sponsored from KFC. We have no affiliation to KFC, and it was an interesting story of where the word Zinger came from. I might get into it one day and openly. I'll do a video on that, separate video one day. May 1, Yum Brands, who owns KFC and Pizza Hut, I think, and a few other ones, opens a new tab reported a fall in quarterly global same stores on Wednesday, hurt by choppy demand for its KFC and Pizza Hut brands from inflation-wary consumers in the US as well as overseas markets. Consumers in the United States are increasingly looking forward for value-orientated meals in the face of sticky inflation, pushing fast food chains to double down on promotions and offers on revamping their stores and order experiences. Did everyone know that back in the 1990s and even the early 2000s that McDonald's used to cook in animal fat, in tallow, and now they cook in vegetable oil, and vegetable oil causes inflammation to your body, and it's a big cancer causing. So the quality of the food, if you go get tallow, a little jar, I've got my glass of water here, right? I cook in tallow, and a little jar of good quality tallow is like $40, right? But you go on the Coles and they've got like 10-litre drums of vegetable oil. Everyone thinks, oh, it's vegetable oil, it's safe, right? It's like cooking the vegetable oil. It's like the same as car oil, right? So the quality of your food, the quality of the things that you're putting into your body is getting worse and worse. So I'd hate to imagine the bad things that will start happening in the, when things get real tough of what people have to let go by. But anyway, there's KFC. KFC's in trouble. Here's another article about KFC. I told you it's going to be food around dinner time, right? KFC names a new CFO amid push to boost sales. The financial leadership change comes to say KFC struggles with dwindling traffic in a dicey economic environment. I can read through it, but I think the headlines are the headlines are telling the whole story about what's sort of happening out there. So Terry says here, you can't beat an ultimate Zinger box, but I'll pass if they're $20. What's a Zinger box go for nowadays? Like $14, $15?
$14.
I remember they're like 10, but that's still good. I think that's like a lost leader for them. Like I think it's very cheap still.
You think they're underselling it, like undervaluing it?
Yeah, I think it should be higher. Like if you think about the cost of the cookers and the wage and all that stuff, it's crazy. But we'll get back to the importance of tonight's Facebook Live. I'm going to be talking about setting up a self-managed super fund and some of the things that we should know about that, and from a very general point of view, in case the communist government officials are watching us. We're just talking in general circumstances, but I think this all ties in together. So hang fire for that. I'm going to go through to my last 3 articles here, and these are pretty fun. So this one here is from the AFR and says the CBA to accept $10,000 to speed up planned construction. Off the planned construction. Commonwealth Bank Australia will allow home buyers to initially pay just $10,000 in the deposit for off-the-plan homes, with the remainder secured by property tax. They're building a platform basically so they're doing, instead of having to pay $50,000, $100,000 for your off-the-plan property and the developer be able to get the funding, this company is going to come in and sort of bridge that. It's like a mortgage insurance for the developers to be able to get their funding out of the ground. Interesting.
Yeah,
right?
it is.
It's a Ponzi scheme on a Ponzi scheme, right? And there's 2 last articles. I'm going to go to this one. It's not to do with property, but I find it concerning, should we call it, right? In any war situation, whenever there's been a massive sort of financial crisis throughout history, right? We look back in the early 1900s and the mid-1900s, you've had World War I, World War II, certain things rise to power, people, whatever. Remember the early 1990s, there was like the wars in Iraq, not the Iraq wars, but you've got, there was a lot of wars that skim over, right? Back in the early 1990s, a lot of civil wars is the word that I was looking for. So it concerns me when I look at the news and I see they talk about Russia and when you say these words, right? Russia, Ukraine, Gaza, see the views drop, right? They're literally dropping. It's like they're trying to ban us when we say specific words, right? But I've seen on the news the other day, I don't watch the news, but I've seen it on feeds and stuff, on news websites, that the UK has pushed for a measure to be had, which is conscription, right? So if you're under like 40 or something, back in the wartime in Australia, and you didn't want to go to war, you had to go to war, right? So in the UK, they're now pushing for young people to go to the war, right?
I think it was that or community service on the weekends.
Probably
that was
something
the
like
two options you could do.
In some places, it was jail time.
Oh,
Jail time. Like you're terrible. Yeah.
I think that's what they were saying in the UK recently.
Yeah. So then it came out in the UK that you have to go to war, and then News.com has this Jackie Lambie chick reveals a bold plan to build a National Guard. And this says here, she's called for Australia to establish a National Guard in the wake of Rishi Sunak's plan to reinstate mandatory national service. The Tasmanian senator has proposed a domestic arm made up of young Australians not working or studying to help the ADF meet the requirements of non-traditional missions such as assisting in natural disasters, pandemic, whatever, right? But, it starts as that. It always starts like, I remember back at the start of 2020, it was just like 2 weeks to flatten the curve, right? Wear a mask and have safe. Then the next minute is like you're locked in your house, right? If you go out, you're going to jail. You're going to get a fine, right? Next minute, you have to go and get these things put in. Otherwise, you're in a lot of trouble, right? And it always starts off with something. So keep an eye out. They're very alarming things that I would see. And it's a fall of an empire. Like every empire that's fallen has had these things. And you'd think it's impossible for McDonald's to fall or something to happen out there. Like these things have happened throughout history. Like Kodak was one of the biggest companies for like 100 years, right? And they made cameras and all that sort of stuff. But at the turn of the century, they didn't go digital. And they go, stuff the digital. And next minute, the digital camera made the business irrelevant. Now they're bankrupt, right?
Yeah.
Blockbuster, right? That opportunity to get Netflix. Netflix was a DVD mail-out system, which was like a Blockbuster subscription. But they didn't buy it, and then next minute, now it's all being streamed. So it's interesting. So this is my last article, and then we're going to get on to the important topic of today, which is about self-managed super fund and jumping into that. This one here is from news.com, and it says, why Australia's housing crisis is going to last a very long time, and it doesn't matter where you are on the ladder, right? So the housing crisis, where does it hurt us? Where does it help us? Waiting for a house? I've got bad news. The housing shortage is going to last a really long time. Official agencies are warning a really long time. That's already a shortage. Vacant rentals are almost impossible to find, and the number of sleeping bags in the doorways at CBD tells you homelessness is right. But even worse news for the shortage forecast is set to get worse over the next 6 years, right? It's bad if you're renting. It's bad if you're trying to buy a property. But if you own a property, your thing's getting inflated away.
Yeah, you're laughing.
Exactly. We'll talk about your laughing in a moment, right? He's got a really good laughing story. So you just wait until you hear what Tim has to say. We may need to bunk up. The RBA has said putting more Australians into each house would help avoid a total disaster. If for some reason average household size rose back to 2.8 from its current level of 2.5, we would need 1.2 million fewer dwellings for the house to stretch, blah, blah. It says here rental vacancy rates are very low, as the next chart shows. If you've seen a massive crowd on a suburban street recently, there's probably some people showing up for a rental inspection. Every time a property is advertised, a horde descends to apply for the right to live in it. So if you look at the chart here, that's 2019, and then it's getting tighter and tighter, lower and lower vacancies, right? And when we drop in 600,000 people a year like we did last year in the country, it's going to get a shitload worse. And that's bad if you're a renter, bad if you're a buyer. But if you're the owner of 1 or 5 or 10 or 20 or hundreds or thousands of investment properties, and the rents are getting inflated away, just like the cost of a Big Mac and the cost of a KFC burger. And that's what we've been talking about everyone about. It says here, if you're buying a house, it's even harder. The price of homes is up 8.7 on average in the last 12 months, more than the capital cities. So this is stats, folks. This is stats. The price of homes is up 8.7 on average in the last 12 months. So everyone sits there, well, not everyone, smart people don't, but a lot of people that are going to wake up to a rude awakening sometime soon, sit there and they're like, I'll just wait for the interest rates to drop. The house prices are going to go up, they're going to fall when interest rates go up. Houses, like properties, like I reckon the properties that we look after, that we buy, have gone up maybe 25% this year, would you say?
Yeah. I haven't seen many go down, that's for sure.
Tim's from Zinger Finance, folks, and we're going to get onto that in a moment. But you're saying, just before we hop the line, what's the percentage of, like, you said there's more refis happening this year?
Yeah, we've just got more refinances happening than purchases, which is a first.
People ripping out equity.
Yeah, ripping out equity, looking for better rates too. I think with the rates going up, people are looking to try and capitalise on
which is exciting.
Yeah, for sure.
And the ability, like, if things were bad, like, you wouldn't see the equity. Like, we'll talk about your equity in a moment, actually. We'll wait until we get into it, right? But yeah, 8.7% on average this year. Is going to get better, right? No, it's going to get worse. So the National Housing Supply and Affordability Council says a shortfall will get deeper in the future. The council's projections indicate that the new market supply will fall short of new demand over the next 6 years, it said in a report released this month. Shortfalls in new supply relatively to the new demand will add to the already significantly undersupply of housing in the system. That is, unless we do something drastically different, which the report said would need to be a significant change in housing policy or the capacity of the housing sector to supply new dwellings. Can we expect tradies to get cracking? The cost problem. You've been to the shops and know what it's like. The cost of everything is going up. Things that go into your house are no different. Hammers, nails, plaster, colorbond, pies, solo for tradies are all expensive than they ever were. Back in 2021, let's say you could buy the house for 400 grand and sell it for 500 grand. Now it's costing, say, 480 grand, and the price of the finished product is maybe up to 550 grand. That's why a lot of builders are going bankrupt at the moment, because they can't make a profit from these things. It actually goes to say the builders are going left and right at the moment, so the remaining ones will want to be cautious, and they'll be able to charge a premium for site when you go to the Easter show and you want to go get a bottle of Coke, and there's like one fridge and everyone's trapped inside the Easter show. So yeah, here's the cost of residential building going up. That's over a period of 20 years. That's 20 years. It's going up. It's going up at a more higher rate than ever beforehand, and that's just the level of inflation. And inflation is going to get a lot worse. And it's an interesting time to be alive. I'm excited by that. Anyway, that's my news articles for this week. Today we're going to talk about super funds. Just before we get started on the super fund topic, I'm not a financial advisor. Tim's not a financial advisor. And none of the stuff we're about to say now will be considered as financial advice, because we're just talking from a generic sense. Obviously, all the things that we say, if you do have specific questions, pop it in, but if we don't answer it, maybe best to contact the office and we can put you in contact with the right people. But before we get into super funds, this is Tim from Zinger Finance.
Yep, that's me.
It's the first time Tim's been on live.
Yeah,
so he's a bit nervous, which is all right. You've already got fans here. Michael says Tim from Zinger is the man.
Oh, hi, Michael.
So you got a lot of fans that are here tuning. It's just, like I said, it's like a phone call, right?
Yeah.
It's like a phone call, right? What do you do at Zinger Finance?
I'm a mortgage broker, so always trying to get people the best deals for their home loans.
Yeah.
Strategize, get their portfolios in a position where we can get them more and more.
Yeah. And I see the numbers that Tim writes, right? Like brokers out there don't write the amount of loans, the volume of loans Tim writes each month. So it's a lot of work.
Yeah,
And I
do a fair few.
I feel bad. I'm always like, can we get this person's equity? What do we get in for this one? Let's move out some equity, right? But you've been doing brokerage here at Zinger Finance for quite some time now. You're an investor yourself.
Yeah, so we were talking about it before. I
Yeah.
bought my first one in November.
Yeah.
Got that one for $199, and then I did a valuation on it a few months later, and it came back at $312. So
up like 50% in
Yeah.
like 3 months.
yeah,
So,
it was really good, really happy. So I ripped out some equity.
Yeah.
Doing my second purchase now, and then we did another valuation about 3 weeks ago, and it's gone up to 400. So it's doubled since I
doubled in 6 months.
yeah
There
it's
you go.
done very well. So now I'm doing my third.
There we go. So 3 properties. You're an investor yourself. You know what people are doing. Like you're sitting there. Like before you came to be a broker, did you sit there and go, "I'm going to buy like dozens of properties"? Or no?
No. After learning it and everything, I think that's what's like given me the motivation.
Yeah. You're seeing everyone go, "Oh, I just bought this property for 200K. Oh, I'm pulling out 50K equity. Fuck!" Like
You see everyone else doing it, you feel like an idiot if you don't do it yourself. Yeah.
That's the thing. That's what we I was telling someone today. I was like, all my team, right? They come in and it's like, you need to know what our clients are feeling. Go buy some properties, and it's like it doesn't like when you add like you get to 10 properties in your portfolio and you got 50 grand increase on 10 properties. There's like $500,000. It's like CEOs of companies don't even earn that sort of stuff, right? And it's like you got 20 of them, 30 of them, and you've seen it, and you're like, "Fuck, I need a part of this." So,
And a part of that pie.
Cool. And say on average, with some clients in the chat here and whatnot, like what would an average sort of client's portfolio like? Would they come in with 20 properties, or would they come in with like 1 or 2 or none? Like
coming in, we see plenty of 0, 1, 2, 3, like around there. Not like where we get them to. We get like 6, 7.
What's the average in like a year or so, the first year or so?
It's a hard question. Yeah, I could say like 6 or 7.
6 or 7.
Yeah.
I don't know. What I think everyone before they go to a broker or a bank, they should be asking who they're interviewing as a broker, like how many clients you like. If you want 1 property, any broker can get you a property, right? But if you want 5 or 6 or 10 or 15 or 20, people should be asking their broker like, hey, how many clients do you have? What percentage of your clients are like me and get me to 10? I don't think they'll be able to do that.
No, yeah. There's some strategy that goes behind it all, obviously, getting it structured the right way.
Yeah.
Like you said, anyone can do 1 or 2.
Yeah.
But it's about getting that 4th and 5th.
Yeah. Before we hop into the super funds, is there anything that you'd think you'd give people tips on, or some things that you'd have that helps them get from like 1 or 2 to 10 or 20?
I mean, like always considering there's bad debt, right? You don't want your personal loans or vehicle loans.
Yeah.
Just because they're going to affect your servicing negatively.
Yeah.
Things like that. Obviously, credit cards as well. They're going to affect your servicing.
And what about going to the bank for the cheapest interest rate? Is that something people should be doing?
Probably not. No.
Probably not.
They're probably not going to help you that much. Their prerogatives with themselves, right? So.
Yeah. And what would be like? Is there a way that you've got? Is there processes that you've seen at the back end without giving all your 11 herbs and spices away? Right? Is there any sort of strategies which have been like sequences of this bank first and refinance out of that bank? Some banks being more favourable.
Yeah, I mean we're going to start with the big 4.
Yeah.
Mainly because they have the best rates. They give you good valuations.
Yeah.
So that's generally where we'll start, and we kind of work our way down, like the second tier lenders.
Yeah. Cool. Cool. Just have a look at always check the comment section, see what's happening over there. But as we jump into super funds, right, I think it's really important. That's why I wanted to get you on today to talk about super funds. So I think a lot of people don't know about super funds. I think a lot of people don't understand what the capability of a super fund is.
Mm-hmm.
And I think that the concept is like, oh, I should leave my super. But when we go through, this is like the perfect timing for this. when we go through KFC struggling, McDonald's is struggling, right? There, you would never expect to see that these companies would be on the headline news of having financial issues, especially in food, right? That's like everyone has to eat every day. Like
It's a necessity.
Yeah. So if these guys are having troubles, right? And you think about what other businesses are having bigger problems that are out there, and you think, well, my super fund, right? The people don't give much thought about the super fund. I always think everyone should be their own financial advisor and should take control of that. A super fund, when I ask people, if you can't answer one of these questions, you should really look into it further, right? Who is your super fund provider? What is my super fund invested into? Is it invested in the shares, in the property, whatever? Who is the person I deal with there? What percentage of my super fund got up in the last year? And just think about inflation. If inflation's at 7% and you had $100,000 in your super, what if the super fund went up to 7% from 100 grand to 107 grand without any contributions? That super fund would still not buy what it bought last year, right? You couldn't buy as many Big Macs, you couldn't buy as many Zinger burgers, whatever. So if we're looking at from the value and the growing up of the asset that you've got in there, the reality is that out of all the fees, a lot of super funds are actually in negative growth, right? So you have 100 grand in there and it's back to 97 grand, right? So it's losing a lot of its value. And we haven't even seen a financial crisis yet, like 2007, 2008. We haven't seen a financial crisis like in 2020 when the shares fell. So I think, if you're 30 years old or 40 years old, you've been working a job for 10 years or so, you should have enough money in your super fund, which could be potential to do a self-managed super fund, right? And we can't give advice on that. We're not financial advisors. We don't profess to be financial advisors, but we're just going to talk about like what we see other people doing and benefiting from in their position. I did a podcast on this the other day, which will come out this week or next week or something like that. But in short, on that video, I deep dived into how to get. Someone just says you're lucky to get any answers from your super fund. If you want to see the biggest scam, go on and ask your super fund to roll over the funds in your self-managed. They won't give you your money back.
Yeah.
You have to beg for it, right?
Yeah.
So yeah, it's an industry in itself. If you took all the money out of super funds, the stock markets would collapse, the bridges wouldn't get built. Like the world's made up of a wash of Ponzi money out there, and I think everyone should have an understanding, whether that's leaving in your super fund, whether it's setting up a self-managed and working out its best viable to do whatever. You should have a concept of where is it happening and where's what is it invested into.
At least have the knowledge of where it is. Yeah.
Correct. So on the podcast that comes out this week or next week, the No BS with Birchie podcast, if the editor's watching this, put it out this week, guys, so then it can flow off the back of this, right? Reach out. You need to get a financial planner. I don't trust financial advisors and financial planners out there. Their advice is not always the best. They try and sell you insurance policies and shares and all those sorts of things, which I don't personally agree upon. And a lot of financial advisors out there don't have the assets, don't have a financial plan of their own that's going to be sustainable to get them through retirement. So you want to understand exactly how everything's going to work for your position. So yeah, with it, go and do your research, educate yourself. There's a lot of red tape. You need to make sure everything you do is compliant and meets regulatory sort of guidelines. But a lot of people are successful with buying properties in their super. Tim, on that note, if you can buy a property in a super fund, can you get a loan?
Yeah, you can. You've just got to make sure you have a bare trust set up because SMSF on its own can't hold debt.
Mm-hmm.
So that's just step one. Basically, you need to go see your accountant about that. So that would be step one. I mean, there's a few requirements. So some banks have what they call a liquidity ratio.
Yeah.
So some banks require to see 10% of whatever the amount is in your account left over after the purchase.
Yeah.
Okay. what else is there?
What LVR do they lend up to?
They can do 80%,
Okay.
but it does vary. So they do have more restrictions.
Okay.
It can go down to 70 or 60%.
So technically, if you get an 80% LVR, right, you got liquidity and stuff like that. So if you got like 250K in your super fund, you could possibly buy up to like 800 grand, 900 grand worth of property, leaving a liquidity buffer in there.
Yeah, that does vary from bank to bank. The 10% of the cash management accounts for some banks, it does vary.
Yeah. So if you had 200 grand in super, and then Gregory says here, anyone know your birth certificate is traded as a bond? That's a topic for another day. Your straw man. That's a whole other topic. But yes, but looking at your super, if you had 200 grand in your super, and that goes up by 5%, if you're lucky, and it goes up by 5%, your 200 turns to 210 grand, right? But if you bought say 800 grand worth of property, that 200 grand gives you 800 grand worth of property. That goes up by 5%, and that's like 40 grand worth of growth for that year. Plus you have the cash flow of the rent, which would pay down the debt, help service from that perspective. So you've got the ability to leverage by getting a loan.
Yep.
In essence. Cool. And the video, the podcast is going out. I was taking a deep dive into people's scenarios and situations. We only talk very general guidance on this front. We don't give financial advice or give you guidance as to whether you should or shouldn't, because a self-managed super fund isn't for everyone. There's some people that it's best to leave them in the industry super fund, and it's important you get the right guidance and whatnot on that front. But could someone buy a property, like we always talk about buying a property for 200, like your deal, you bought for 200, ripped out equity, bought another one, ripped out equity. Can you do that in a self-managed super fund?
Yeah, no, you can't release any equity. So whatever you're buying, and you can refinance, but it has to be dollar to dollar.
Yeah.
So you're only doing it for better interest rates.
Yeah.
But yeah, no, you can't release equity. You can only do it based off the funds that are in your cash management account.
Yeah, cool. And then the other question I was going to ask you.
I was going to say as well, just with like the documentation, right? So if you're self-employed, it's going to vary from whether you're POIG.
Yeah.
So if you're self-employed, you're going to need 2 years of contributions consistently. That, again, generally, it's not with every bank, but with 90% of them, that's the case.
Yeah.
If it's just like a POIG client, they're just going to calculate it as the 11%, your employer's contributions. And if you're making any additional ones, they'll include that too.
So let's say, for instance, I don't know, I'll just make up a scenario here. Let's say that I was married, I'm 30 years old, 10 years younger, so that's good. 30 years old, and I don't know, I've got 10 properties, and I've got 5 kids and a missus. The missus doesn't work, the 5 kids are bleeding me dry. I can't get a loan, my servicing doesn't work in my personal name. Can I get a loan in my self-managed super fund? Is that a possibility?
Yeah. They're going to assess it completely separately. It's the SMSF on its own. So it's in the income and the outgoings of the SMSF.
Yeah.
It's nothing to do with your personal situation. You can see it as a completely separate thing to your personal name.
Yeah. So they look at the super fund as a SPV, which is a special purpose vehicle. And then with that, the loans are non-recourse. Like what happens if I don't pay the loan in the super fund? Do they come and take my house off me?
Yeah, so they'll claim it from the Bear Trust individually, right?
Yeah.
But it's not going to affect your actual super fund.
Yeah.
So that's why you have to set up multiple Bear Trusts for every property, so each one is protected.
There we go, folks. There we go. So it's interesting when you take a deep dive in there, because just me asking you those questions, it's like, there's something I think people would be watching going, shit, like, what happens if I do this? Like, I'm stuck. Like, I see comments all the time where people are like, I can't buy a property because I can't get a loan or whatever the case may be. But, they haven't looked afar, right? Like, you could buy maybe 5 in your super fund. You might be able to buy 3. When it comes to retirement age, the loans pay themselves down and you can sell it. There's tax benefits. You can pay out debt on your personal names, all different sort of options there. So, how does it work to get a loan in a self-managed super fund? What's the process look like? Yeah.
To be honest, it's really similar to just doing it under your personal name. I mean, it's different from our end. The way that we process the loan is very different, but from the consumer's end, it's going to be very, very similar, yeah.
And I always know when someone comes to Zinger and they say, "Oh, you buy me 10 properties," you bought them 10 properties, and then they go to do a self-managed super fund loan. The conversations like that I get sometimes are like, "Fuck, is that?" It's never for you, Tim, but it's like it's just been over the last 10 years or 15 years of that. We're like, "Oh, is the person okay? Like, it's taken really slow for this one, right?"
Yeah.
You said it's different at your end. Like, is it much harder to get? Like, is it much more? Is it like labour intensive or?
Yeah, I mean, we have to do manual submissions with some banks, so
Yeah.
it's not like an online system. We have to fill out some forms. Like, yeah, it's a real pain.
Yeah.
And then, yeah, the assessment's a bit more critical as well because it's your super, right? It's meant for your retirement at the
Yeah.
end of the day. So
There's all the red tape around it.
yeah, exactly.
And just backing up what Tim's saying there, like going back. So here's the other question: do all banks do super fund loans, or?
Yeah, no, only a few. I was looking at it recently. There's a couple new lenders that we've been using that have only set up over the past like 3 years.
Okay.
So yeah.
There used to be, going back 10 years ago, like all the big banks did self-managed super fund loans and stuff like that. But now it's only a small handful of lenders, and it's all manual, like Tim was saying. I remember when St George and Westpac and that used to do self-managed super fund loans, it would be a manual process where it's all paper based, right? And nothing's digital. It all has to be in paper. The file comes over to someone else's desk in the head office, and then he sits down and goes 1, 2, 3, and then what was I going to say? Yeah, it's just very, very manual. If there was an exception, which is like, what's an exception?
Like a condition. So if the bank needs additional information regarding your scenario,
Yeah.
essentially.
So if there's an exception, what would happen is that your file would go to the bottom of the queue, right? Back in the day. Is it the same now?
Yes, the same thing. Yeah.
It's not like, oh, we've got your file, tell us this. Oh, yeah, cool, we'll put it in. It's back at the bottom of the queue and it takes another week to go through. So the tedious compliance and red tape around it is really...
Yeah, it's really frustrating, especially when it's just like a simple thing. Like they might just need an additional payslip or something, and then you have to wait an extra week for it to be assessed.
Crazy. So say we set up a loan. Let's say I've set up a super fund. I'm just making up a scenario here, so don't quote me for any financial advice or telling you what to do out there. But let's say I've got 200 grand in my super. I've rolled it over, got myself a super fund. I've set it up. And here's the other thing as well. You might be sitting there going, you've got 50K. And 50K, like, without me giving too many little secrets about a super fund away, like 50K, it's probably not worth doing a self-managed super fund. A lot of people, if someone set up a super fund with 50K in it for you, there'd be a lot of trouble for that person to be able to do that. But multiple people can do a self-managed super fund, so like up to four people can get together. And let's say someone had 200 grand in the self-managed super fund, and they came to you, Tim. What would be the process of getting a loan? Like if I said to you, I've got 200 grand, I want to buy 3 properties at 200 grand a piece. Is that something that could work, or is it?
Sorry, say the numbers for me again, so I'm using the right things in my head.
So let's assume that I've got 250K. Let's say 250, just so right?
Yeah,
I've got 250K, and I want to buy 3 properties for 200 grand a piece. So 600 grand worth of property with my money. Obviously, noting that I have to look after the liquidity, have money left over.
Yeah.
And the reason why you need to have liquidity in there, folks, is to like, it's got to be self-sufficient. It's not a recourse loan, so you need to have funds. You can't just rape and pillage every cent of it out. You can't go and take the money and use it for yourself. It has to stay inside of that. It's a special vehicle for that. But let's assume that I've got 250. What would be the process? I've got 3 properties here today, 200, 200, 200, 600 grand worth of purchases. They all rent out for, say, 350 a week. So I'm getting like 1,050 a week. What would you need from me and the process and the documents and stuff like that to get those loans?
Yeah, so we're going to need your SMSF deed. We're going to need your bare trust deed for each individual security, because as I mentioned before, you need an individual one.
Yeah.
Your income documents, so if you're a PYG, your pay slips. If you're self-employed, your tax returns. The rental appraisals, the contracts of sale, your So the cash management account, we also need 2 years history of super contributions. So
Yeah.
say you've set up your super fund within this year, so say you set it up a year ago,
Yeah.
then we need a year of your retail fund or your industry funds contributions from prior to then.
Okay.
That's the majority of it. I mean, there's some other things that will change from bank to bank, also depending on your personal scenario. But yeah, that's the general documentation that you'd need, yeah.
Cool. And when people come to you and say, oh, tell me about a super fund loan, like you'll have a chat with them about, okay, this is what's possible, this is what borrowing could look like, whatever. When someone, like, if someone hasn't set up their super fund and they have to go off and set it all up, how long does that process usually take?
To set up your super fund?
Yeah. He's smiling, he's like, so.
It can take some time.
Months?
Yeah, it can take months, especially like you were mentioning before, the rollover.
Yeah.
The rollover can take, a really long time.
Yeah.
Yeah.
Cool. I see some people say, oh, I'll buy the property cash, we'll go get a loan on it later. If I bought a property cash today, I want to go get a loan on it in the super fund, can I do that?
Yeah, no, it's not going to be possible. You have to get a loan from the start.
Yeah. So it's pretty crazy. What are some of the benefits that you see of having a loan? And like, we can't give advice about benefits of a super fund. Is there any sort of benefits that you see from the clients that we work with, and some of the things that they've been able to do in a super fund?
Yeah, well, like, I mean, when they're maxed out under their personal name, they're able to continue growing their portfolio through their super funds. So obviously that's one big thing there.
Yeah.
I guess also, I mean, yeah, again, I can't advise, I'm not an accountant, but yeah, it's beneficial.
Advisor.
Yeah, it's beneficial for when it comes to like retirement, right? You hit that retirement age and you don't have to pay any capital gains if you're selling the property, right?
Yeah, yeah. There's a lot of, I think as special purpose vehicles, that there's a lot of benefits there as a tax minimisation tool when it comes to a self-managed super fund. As I said, like I did a podcast purely on this the other day. You can find it on Google Play, Apple Play, Spotify, YouTube. Comes out every Thursday. I'll ask the team to put it out this Thursday. With the self-managed super fund, what I find a lot of people's strategy is, it's like, if you have 200 grand in your super, this is a hypothetical, 200 grand goes up to 205, maybe 210, it goes up. If you have a bad year, it might go back to 180, whatever, right? But if you have a property and it goes up by 5%, your 200 grand gets you 700 grand, 800 grand with, let's say 800 grand just for the fun of it, 800 grand with a property, that goes up by 5%. Let's say it doubles in 10 years and it doubles in another 10 years. That means the 800 grand might turn to $2.4 million. It goes to 800 to 1.6, 2.4, just being very conservative here. And if those properties pay themselves off as a principal and interest over the course of 20 years or whatnot, and you've got $2.5 million when it comes to retirement sometime, I've had a lot of people say that their strategy is that they want to use that to pay out the debts under their personal portfolio, and then there's all the tax benefits and stuff like that. So it's how does it fit into the overall strategy? What risk levels do you have? I've seen some really dodgy sort of setups of people setting up super funds for people, especially around cryptocurrencies and stuff, where they go, oh, let's set it up for 50K, and the next minute it's put into some Ponzi scheme, and the accountant or the financial planner's gone for a runner, and they're in the Seychelles, whatever the country is, island. But you do need to make sure that you have a good understanding, educate yourself on a super fund, educate yourself the benefits of it. Is there any other things that you could share?
Like if you're looking at repayments, you can do interest only or principal and interest. It's up to you what you'd prefer to do. I was just going to say before, with you saying that the asset's going up, you also got to keep in mind you're getting rental income the whole time too, right?
Yeah. If you had shares or whatever it's in, if you got your 200 grand, they place it as units in your super fund, in your industry super fund, like those units just go up. Like when you invest your money into a commercial property fund in your super, that doesn't mean you own a part of a Westfield, right? It means that it's a cash flow booster account or whatever shit they call it. it means that your money could be tied up as a derivative, as a bond. It's someone's loan. It's like, I know a shopping centre wouldn't go out there and go, oh, hello, you Commonwealth Bank, can you give me a 95% LVR on my shopping centre, right? That's not how they build a new car park or extend. They sit there and they go, okay, well, here's a bond, here's a proposal. We want to see what industry funds will give us the money, and they might go, we'll give you a 15-year bond at 6% rate, and then your money is just becoming your super is someone else's loan, right? And they make all these. You've seen The Big Short, you've seen The Wolf of Wall Street. These are the fellas that are, that are playing with your money. So, yeah. What are some potential risks that you see?
I mean, if you
And how can you avoid it?
if you lose your job, that's going to be a big one because you're not going to have any super contributions there. Any other risks? I mean, like just the standard property stuff, really. But yeah, I was going to mention the interest rates too. You're going to be finding around the low to high sevens.
They're pretty expensive in there.
Yeah. But in regards to risk, I mean, I guess it would just be the standard property stuff. You want to make sure that you're.
Yeah. The properties are self-liquidating, like they've got cash flow coming in to support themselves. Understand the big overall picture as to what's the super fund trying to achieve for me. You need to factor all that in. You can chat about it with your financial advisor. Tim is not a financial advisor; he does the finance, right? Tim's from Zinger Finance, and he can help you, and the team can help you with getting the funding for your self-managed. Like, what other things do we do finance for at Zinger Finance?
I mean, we can do home loans. It's not like we just need to do investment loans, SMSF, commercial. You name it with property. I mean, we can do it. So.
Builds, like construction finance.
Construction, off the plan.
Yeah. Development finance. Finance is there's all different types of layers of finance. We're not doing car loans. We even do car loans if people wanted to, but we don't.
We don't generally. But
we don't advise. We don't suggest car loans because it hurts your position. But anything when it comes to finance, whether it be super funds, pulling out equity. Tim's the master of pulling out equity. If you weren't watching at the start, you've just bought a property, 200 grand, revalued it for 312.
Yep, 312.
And then what do you revalue it again at?
400 now.
400. You bought the property 6 months ago. You've revalued it twice, right? We understand how finance, how finance works, and that's what we do for people every day. Someone just says, is it true that Woolies and Coles don't pay rent in shopping centres to get traffic in? They pay their anchor tenants. I'm not an expert on this front for Coles and Woolies and these anchor tenant sort of shopping centres, but they do have special provisioning to attract all the other tenants that are in the properties. Random questions. So if you've got questions, flick them in the comments section. We'll get to them very shortly. Do you have any examples of some people with super funds that you could share without giving too much information or divulging some people with strategies or examples of what people have been able to buy in their super?
Yeah, so we had one that was like a 600K multiple units on one title property, and that went through with one of the lenders. Obviously, you need to make sure in that case they had enough funds in their super to complete it.
Yeah.
I mentioned to you before that you need 2 years of history.
Yeah.
I have had policy exceptions. I've been able to kind of pull some strings with the lenders to get it over the line, some policy exceptions there. So that was a big win for us.
Okay, awesome.
And then, I mean, as we've been mentioning, the clients who have those personal portfolios where they've pretty much maxed out, we've been able to get a few more under their SMSFs. So it's always a good option to look into.
And on average, like, what's the largest, like, because it's not like, it's very controlled, right? And I always, like, I say in jest about government, regulatory bodies, all that. One thing I do give credit to when it comes to your super fund is you want to make sure that whoever you're going to for advice or setting up that super fund it's done with very good compliance, because when you're setting up a bear trust, it's it's a 30-year loan. How long's a loan in a super fund?
30 years.
30-year loan. So you've got a 30-year loan. How many people? Super funds and lending has only been around for like 10, 15 years, right?
Yeah, it's new.
It's fairly new. So how many people would have bought a property in a super fund and then paid out the mortgage in their super fund? There's not many, right?
Not many.
And you're not refinancing to pull equity and whatnot. So when it comes time to pay out your mortgage in 30 years' time, 20 years' time, however long it takes you to pay it out, then that bear trust disappears. Right? It drops basically the bear trust drops it into your super. If it's not executed right, there could be tax implications.
Yeah.
For poor compliance, right?
Yeah, I believe it's like you double stamp duty. Like if there's anything different between the contract of sale and the bear trust, there's also signing orders. So in New South Wales, I had it written down in case I forgot. The New South Wales, you need to have your bear trust signed after the contract of sale.
Yeah.
And then in Queensland, it needs to be signed before. Yeah. And then Victoria and WA, it doesn't matter.
So if something goes wrong in that process, it could be invalid. It could come back and trigger another tax.
Yeah. I believe double stamp duty. So don't quote me. It'd be something to check with your accountant and financial planner. But,
So on that front, how many servicing is a big thing, right? Because most people cap out at about 25 grand a year worth of super that they can put in there without getting tax heaps. So most people's super funds get up to 25 grand a year. Not many pay over that to pay its full tax. What sort of average sort of properties like people get like 2, 5?
How much they get under the
super fund?
Probably like 3 to 4, probably between what you said.
Yeah. Like I haven't seen people with 10 in their super fund. I've never seen a 10. Maybe like a 5 to 6, 7 if we're really pushing that. But they're few and far. Like if I tell you I've got people with 10 properties in their super fund, like every second person in their personal name, every second person's getting like 5, 10, 15 in their personal names. But when it comes to the super fund, 3, 4,
it's
like
a lot more restrictive.
Yeah.
I mean, there's less income coming into it, right? So.
Yeah. Cool. Any other thoughts or tips or anything like that?
No, I mean, I think we've covered the majority of it. There's still some lending things, obviously, that are specific to your scenario.
What could some of them be?
I mean, if you're purchasing certain properties, there's going to be LVR restrictions. If you're self-employed, like I mentioned previously, you need to have the 2 years. There's a lot of security things, so that's the big one. They're a lot more critical of the security that you're applying for the loan for.
Because they can't. If you default on it, they can't come and chase you. So they want to make sure that they're protected. So what sort of security things do they look at?
They want to make sure that it's earning a rental income. So you need to be able to see that it's earning something. And then the area, their postcode restrictions are a bit more strict. And then, I mean, with certain lenders, they'll just restrict it if it's a unit. Like if it's an apartment, they're immediately putting an LVR restriction on it.
Okay. And if it's in a complex of X amount of units, like there's too many units, they'll lower the LVR.
They'll lower the LVR. It's not like it's not possible though. Under your personal name with certain banks, if you have too many units on one title, it turns commercial. But with super funds, they'll still lend.
Awesome. Cool. And I don't know if I've got any more questions here for you. How would this is a question that someone's put down here for us today, but you can't answer it in full. But how would someone get started with a super fund? What would be the first thing?
Setting up their super fund would be
You don't set it up.
No, you have to go to your accountant and get that one set up.
Accountant, financial planner.
And then once all of that's done, just coming to us so we can get the serviceability assessment completed. Then we'll let you know what you can do, how much you can buy, what your borrowing capacity is, etc.
Beautiful. And if you do go down the road and you feel that setting up a self-managed super fund is the right thing for you, you need to make sure that you've got all the insurances, like the way it's rolled over, the way it's set up. I'll go into a deep dive on that on this week's podcast that's coming out on the B.Invested podcast, which could be a follow-on. Watching this before that one comes out, but important that you get all the regulatory stuff set up for it. Cool. Well, I'm sure people have got questions for you, Tim. So for those of you that have tuned in a little bit later today, Tim is from Zinger Finance. He looks after hundreds of our clients that are got all different walks of life. Average portfolio size when people come to you, average portfolio size that you've got working at the moment, how many properties do people have?
Coming to me, I mean, I generally say 1, 2, maybe 3.
Yeah.
And my average portfolio size would probably be 6 or 7.
6 or 7. There you go. Well, they say there's less than 20,000 people in the country with 6 or more properties in their portfolio.
So I've probably snagged a few of them.
You've made a few of them.
Yeah.
You've made most of them. You've made most of them. So he's very humble about what he does. He's like oh, it's just not what I'm doing. So yeah, if you are thinking about getting a loan or you've got a loan and want it revisited, there's a link in the video wherever you're watching this. There's a little link which is zingerfinance.com.au/financial-health-check/ click on there, reach out to the team. I think that might direct you to Tim's calendar or to the team's calendar, depending how bombarded Tim's going to get today. And have a chat with Tim and have a review of your position and see what you can do. From there. Got some questions here, and as we get into the questions, someone said, "Is it Nathan's birthday this week?" No, it was a birthday the other week on the 18th, and thank you for the wishes. Sam says here, "Happy birthday for the other day, billionaire in 12 months if inflation does its thing." Look, when I said I wanted to be a billionaire by 40, I'm 40 next year. I'm going to take a little bit of water here after saying that. But I'm hoping to be there. And even if I did nothing else today and just wait the next 1 year, 2 years, 3 years, inflation is going to do its thing and make me a billionaire, right? Even if I just do nothing. So everything, I'll be a billionaire by buying a Big Mac meal by the end of this. It's a fun time to be alive. Vinay says here, are construction loans harder to obtain than an investment loan?
I mean, not necessarily. There's a few more things that we have to do from our end, but I mean, yeah, not particularly.
They can be troublesome, like if you're building a property and you're doing a construction loan, then it does limit, because the bank takes that as an expense, but doesn't calculate any of your rental income in 12 months.
Yeah, there's no rental income. Yeah. So it does make servicing harder, but it's not too much harder on the actual application process or anything.
Yeah, cool. See how cool it is. Doesn't make it that much harder. We'll sort it out.
We can get it there.
We'll get it done. Zach says here, what are the key factors that set you apart, Tim, to be able to get people to 6 or 7 threshold versus other brokers?
It's just a matter of knowing which lenders to go to, I guess. Understanding their policies, being able to take advantage of those things.
Yeah. Every time, I reckon half the time I come to the office, I don't come to the office as much nowadays. I'm on the phone. I was talking to Zach the other day on the phone while walking. When I come in the office, I reckon half the time I see the whole Zinger team in this boardroom, and there's like someone from a bank here, and they're giving you a breakdown of what's happening in the policies and all that.
Yeah, we stay informed for sure. I mean, it's necessary, really, especially with we have such a broad range of investors, right? We have such a big client base that we need to make sure we know where to take them for every specific scenario.
Yeah. And the other thing I think as well, and this is like so underrated. This is so underrated about your team, right? Your team, like. When you go to a broker, you've got one person that's sitting there, right? Or 2 people, right? A brokerage firm may have 1, 2, there's more businesses, whatever. Like, I have to make smaller desks out here to get more of you guys fit in the office because our office isn't big enough, right? We have to share the car spaces because there's not enough car parking in the building. In your team, we've got like going on dozens of staff, right? If there's a problem or if there's a situation where someone, like, you can't get a loan, you'll workshop that around your team.
Yeah,
You'll be
exactly.
like, oh yeah, I've got this client, their position's this. Anyone got an idea of a bank? And the next person will turn around and say, Tim, I had a situation like that. And you have the team around you that you can bounce all the information off. And,
Yeah, it's not just me. There's 13 other people there who have
Yeah.
experienced a lot of loans. So yeah.
Yeah. So it's that knowledge, and Tim's, like, as I said to everyone to start off with tonight, Tim's got like the most amount of like clients. I look at the amount of loans you write, and like a broker wouldn't write that amount of loans. They might like 2 loans or 4 loans or 5 loans or 10 loans or 20 loans in a month. This guy's got like 50 refis happening in a week, right? It's stupid. So yeah. Nick says here, what are your thoughts? Zach said sweet, great answer, by the way, for you. Happy birthday, dude. Have learned so much from the Facebook Live. Thank you, I appreciate that. And humbled that you enjoy these videos. What are your thoughts on family guarantor, Birchie? Do you have many clients that have gone down this path? I'm going to answer that one. I'll ask you your thoughts on this. So I think what you're asking me is that if you need a deposit for a property, or you don't service enough, you pull mum and dad into the deal, right? Mm-hmm. And I see people, and it hurts me when I do strategy sessions with a new client, and they go, my broker has set up my position where mum and dad have gone guarantor, right? So let's use an example. Mum and dad have a house worth $1 million and owe nothing on it, right? And then the kid wants to go and get a loan, so they're buying a property for 500 grand or 200, let's say 500 grand just for the fun of it. So you'd need a $100,000 deposit and say 20 grand closing costs roughly. So what the brokers tend to do is they'll guarantor and they'll cross-securitize the mum and dad's property with the new property that's being purchased and go, there you go, it's all safe. But what they've done is they've tied you with your parents' position. So let's say mum and dad want to go and retire in like 2 years' time and they want to sell their house. They may not be able to sell their house. They may not be able to do something because your property is attached to it. What I've always thought, and this isn't giving advice to anyone here, everybody's position is different, what would be a safer position for mum and dad and a safer position for the person that's using them as a guarantor is if they were to pull out the equity of 200 grand and take out, 100 grand and take it out as a loan and be able to use that as a 20% deposit and gift it to you, and then your position is totally separate. But a lot of brokers, a lot of people will try and tie that shit together, and I'm not a big fan of that. What's your thoughts?
No, it makes it way more complicated. And then if there's a loan on the existing property and then you're crossing it, and then like you're saying they want to sell it further down the road, you need to make sure that both of the valuations stack up.
Yeah.
Because if one of them comes back low and the other one, well, say they both come back low, you're in a lot of hurt. But yeah, if one comes back low, it's going to make it a lot more complicated when you're refinancing it. So it for that matter.
I've got a question for you. It reminded me of a conversation from yesterday on a map session. The person who's watching will know this. If someone was to go, let's say they've got a house for like $500,000 and it's worth $1 million, right? And they'll pull out equity. Would you suggest that let's say the property's worth $1 million, they owe 500, they can get 80% of $1 million, so 800 grand. So there's 300 grand in equity there. Would you suggest with that 300 grand that you just go and use that property as a security and add 5 200 grand purchases to it? Or would you suggest to pull out the 300 grand in equity, put it in an offset account, and then use that as deposits for individual properties? Not that we can give advice on that, but what would you do for you personally, and why?
Personally, I can't say whether to or not to. It's everyone's decision.
Yeah.
But I'd release the equity and then use that as a deposit for another few more properties.
Why?
You're able to buy more. Then the interest is going to be tax deductible at tax time on those 3 properties that I'm buying as well.
And you're not tied together.
And you're not tied together.
Reevaluation.
If they're all tied together, you're
screwed.
Yeah, you're screwed.
And if you go and revalue them and the value doesn't stack up, or you don't service with the bank that you're currently with, you can't.
Yeah, you can't move them. Yeah, so they're all tied together. So if you just want to move one loan away,
You're screwed.
yeah, you can't. You'd have to move all of them. So.
And then, so out of your clients, so you've helped, let's call it hundreds of people for their exercise, get to half dozen properties, whatever in their portfolio. How many of them would you have crossed the loans on?
Zero.
Zero.
Yeah, I don't think I've done one.
Tim has done lots of loans, right? When I tell you guys, he's done lots and lots of loans here. This thing is just so blurry.
Yeah, it does.
We're getting new cameras soon. We're getting it linked to all platforms too, so it's not going to be a Tuesday night Facebook. It's going to be YouTube, Facebook, Instagram, Facebook, different channels in Instagram, different channels in Facebook. It'll be cool. That'll come in the next few weeks. But Tim just said he hasn't done one property that's crossed, not one.
No, I haven't crossed any. Yeah.
Ask your broker how many properties they've crossed together, how many they don't cross, how many have 5, 10, 15, 20 properties in their portfolio. And so you go, oh, well, we've got one guy that wants to get to 4 this, in the next decade. And, they don't go, oh, how many clients have got to 0 to 5 properties this year? Right? How many clients do you reckon this year have come to you with no property and got to 5? Or 1 to 5? Or in the last 12 months?
In the last 12 months, I don't know. It's a hard number to guess, to be honest with you.
Okay.
I've probably made
You've done?
I've done it, yeah.
Like,
I could say 10 maybe, but
10?
yeah, I don't, yeah.
Zero to, people go, oh, it'll take 1 property a year if you're lucky for the next 5 years or 10 years. It's like, no, we can do it. And, what's the most that you've done what's the quickest time to get someone to 10?
I don't know. There's been a few where it's been crazy, where it's been like a few months.
A few months?
Yeah, there's been some that's insane.
Are they coming to you with $1 million in their bank account and going, oh, give me a loan?
No.
No. Do they come to you with 100 grand in their bank account, or sometimes they come with nothing?
Sometimes they come with nothing, yeah.
So they come to you with nothing, and you get them like 10 in a year or something.
Yeah, but the ones that come with nothing, they might have like a property in their portfolio already.
Yeah.
That we're able to take advantage of. But yeah.
The structuring taking advantage of. There's lots of people out there taking advantage of people, but always find the humour in things. So with there's more questions coming through. So this you're very popular today, Tim. Sam goes to the advantages of property-based super funds differ with age for someone. Too many questions coming. For someone younger, plenty of time to grow to a 65-year-old 500 super fund. I'll answer that one, Sam. With the super fund, the strategy would be different. I always get nervous when I get a referral from someone to someone's parents and they say, oh, I'm going to retire in the next 5 years. I'm 55, I'm 60. What can I do with my super fund? And I don't give advice on that, but it's like, the structuring, the types of properties, the debt, it's a different, you need to get financial advice on that sort of stuff, but it is very different in short. They just raised another question for me. Tim, if someone was 60, could they get a loan?
They can. They just need to have an exit strategy.
What's an exit strategy? What do you mean by that?
So, if they're going to pay down their loans after they retire, they're going to need some form of strategy there. So income from other investments, income from their super, sale of assets, downsizing. Yeah, they need something there. But it's possible we can get a loan.
Because a 30-year loan, if you're 60, is going to mean that you're 90.
So you're going to retire at some point.
Yeah, it's crazy. So, so definitely possible. GoFundMe to get Nathan new cameras. After maybe a month ago, I was like, I'm sick of this camera. It's only 2 years old. It's okay. It's like a webcam type camera. And I've got this ring light that sits up here and it has little prongs. And I saw that you can have 3 phones on it, right? And I emailed my team. I was like, fuck this. I want to have 3 new cameras. I want a YouTube camera. I want a Facebook camera. I want this camera. I want all of these cameras. And then we've got a new guy. He goes, no, we don't need to do that. We need an app, and we need to get a high quality camera that does blogging or something that sits here. I was like, one camera, that's mad, right? So it'll be cool in the future. So we're just waiting. I'm like, this is above my pay grade. I don't want to know about the camera. Just get it set up right. So it's good. Matt goes here. If you have two properties crossed, can you release one if you have the equity?
Yeah, you can release one if you have the equity there, as long as the valuations are stacking up.
Yeah. So someone has a property. I've seen this years ago. I had a guy come to me, and his wife had passed, and it was like 15 years ago. And he's like, I've been through the GFC. This was in the GFC, right? And he's like, I've got this position. I was like, fuck. Like, he bought these properties off the plan. They've gone backwards in value, all this sort of stuff. He's like, I'm going to sell it, fix out the wife's position, whatever. And then the next thing is that he went to refinance. He sold the property off, right? The property was crossed, and because of the GFC, the property was crap. He bought it off the plan. There was a couple of them, and he sold the property to get money to pay for his wife's position at the time. And the property had gone down in value, right? So the property he had like 200 grand in it, right? But the other property it was crossed to went back by 200 grand or 150K, right? So the bank gobbled all the position, and he was left for like 50 grand. And got him through, but like, fuck, that's like ugly.
Yeah, it would have been a lot different if he didn't have it crossed.
Correct. So it's like, yeah, it's really important to yeah. Are you starting to see lenders relax serviceability criteria to write more investor loans, given the interest rates are still high?
Yeah, I mean, over the past few months, there's been some policy changes with the second tiers that have made it a little bit more lenient.
Yeah.
But I wouldn't say like across the board. No,
Yeah.
it's just certain lenders want to increase parts of like their portfolio.
Yeah.
So yeah.
One thing that I would say that I have seen, and it's in the news, I didn't have the news article today on it. I just think of it as like common sense stuff for me, but I'm like, I should have sent it over to print out and put on my list of articles. Is one thing that I've seen is that some of the banks are starting to lower their fixed rates.
Yeah.
Yeah. And it only occurred to me yesterday. I was having a chat with a credit assessor actually of a bank, and it's like the bond market is starting to fall, which the bonds are based on where the banks are buying the money from. And the bond market's falling because the financial market's a bit shaky out there. And that's the indication that we're going to see rate cuts, which are going to be coming. And I haven't called it yet, but I think that we're probably 3 months off seeing our first rate cut, possibly. So I'll come back with a video on that and a specific timeline and all my evidence behind that, pulling out charts and stats and graphs, and we'll throw heaps of paper around, and maybe a video for next fortnight when we catch up. But just something I've seen out there recently. You're seeing that they're dropping there.
Yeah, definitely.
Cool. Well, on that note, folks, I'm going to leave it at that. I've been here for an hour and a bit now, and if you guys need help on your portfolio, reach out to Tim, reach out to the team as well. Click on the link in the description, and booking a health check with Tim. Just on, here we go. I've got one last lucky question here from Monica. What type of income does your typical client who gets, say, to 10 a year have? Like, are they PAYG, business owner, any complex client income streams?
I mean, everything you've listed there, to be honest with you. We get some PAYG, we have some business owners, we have some that have incomes that are coming through different trust accounts. It really does vary.
And that triggered me for a question for you, actually.
Mm-hmm.
Say if someone was to build a portfolio of, say, 6 properties, right? They get some into the top 20,000 people that have 6 or more properties in their portfolio.
Mm-hmm.
What would be an average income for our investors that have, like, just their salary income, that would have that? Would it be 50 grand, 100 grand, 150K, 200 grand, $1 million?
Not that high.
Yeah.
It would probably be like, I don't know, it could be 75 to 80, but you need to keep in mind that it really does depend on other parts of your scenario, right?
Kids, missus,
yeah,
working.
your rent, yeah, existing personal loans, vehicle loans. It's not just your income that we look at.
So say, for instance, we have someone rock up today that's 25 years old, single, no spouse, no kids, living at home, no rent, no car loan, 100 grand in the bank account. Would someone in a position of 75 grand a year, you think, could get there?
Yeah, definitely.
The thing I think everyone needs to realise is, you're on 75k a year, you go to the bank asking for a 200 grand times 6 properties, that's 1.2 million loan. But by the time you get 6 properties in, and say the rent's $400 a week, that's another 120 grand a year. So your income's no longer 75k, it's now 195k.
Yeah, that is shaded though.
Shaded,
Yeah.
Roughly, what are they shaded by? Just
80 to 90% the rental.
so what Tim's saying by shading is they will, like, let's say you get $400 a week, 52 weeks is like 20,800. So let's call it 20 grand a year. The bank will only take 15, 16 grand or 18 grand of that income as income. Yeah. And they'll take the other 10, 20% of those expenses, council rate, strata.
Yeah, that depends on the bank. So some of them will take your investment property expenses on top of that.
Yeah.
Others will just shade it. That's it. Yeah.
That's why you need someone like Tim in your corner, because not one bank will get you to retire. You're going to need multiple banks, multiple strategies, and without the finance, you can't acquire the assets.
You can't be afraid from moving away from the big four either. Some of those second tier lenders can really help you get your portfolio up there.
And what's the difference between the rate? Like, is there a big difference in the rate?
There can be. There's promotional offers at the moment with certain lenders, so you could be getting 6.52 with ANZ. And then with First Mac, if you move your owner occupied over with them, they'll give you 6.88.
Yeah.
Otherwise, it's 7.44. And I'm talking about investment interest only here, because that's generally what we do.
Yeah.
So
0.25% to a sorry, I've got a dry throat. Too much talking. So 0.25% to a 1% difference in rate. But reality of it is that if you did take up a rate like that and you do structure it right, you may be able to refinance it back out in 6 months, a year, 2 years.
Yeah, you always need to come back and revisit, especially with if your position's changing. Bank policies always change, right? So they might decide that they want more investment loans as part of their portfolio, so they might make the lending more lenient there. So it's always worth just having a check.
Yeah, and I think it's like, if you have a loan today that was written 2 years ago, it's good to look at refreshing it. If you've got a loan that's and in the last year or 6 months or 12 months or whatever, the wife has gone back to work, or your rent has gone up, or you've had a pay rise. Like, a lot of people may not feel that they can service, but 6 months ago they got a pay rise. That pay rise could be enough to push them up. They're getting an extra 10 grand a year. A rate cut, when those rates start dropping, everyone's servicing is going to go boop, 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 all the way up.
Yeah, so, it's going to be a busy time.
Yeah. Cool, folks. Well, thanks a lot for that, Tim. Appreciate that.
Thank you. Cheers.
Thanks for helping out all our investors and help reach cool goals with their finances.
Hope you can keep doing it.
Awesome, mate. We'll catch up soon, folks. Make sure that you tune in to next fortnight's Tuesday Night Live, and this week, the No BS with Birchie podcast. I'll be talking about self-managed super funds. No financial advice there. We didn't give financial advice today. We're not giving financial advice then. And just explore the concepts. If you do need help on being put in contact with the right people, whether it be a financial advisor, whoever it is to help you with building out that super fund strategy, reach out to us and we can put you in contact with those guys too. Catch up soon. Have a great week. Bye for now.